Cash accounting and accrual accounting, why it is important to know which to use. The difference between cash and accrual accounting lies in the timing of when sales and purchases are recorded in your accounts. Cash accounting recognizes revenue and expenses only when money changes hands, but accrual accounting recognizes revenue when it's earned and expenses when they're billed, but not paid. Understanding the difference between cash and accrual accounting is important for business, but it's also necessary to put this in context by looking at the direct effects of each method. Imagine you perform the following transactions in a month of business. Sent out an invoice for $5,000 for a web design project completed this month. Received a bill for $1,000 in developer fees for work done this month. Paid $75 in fees for a bill you received last month. Received $1,000 from a client for a project that was invoiced last month. Using the cash-based method, the profit for this month would be $925, $1,000 in income minus $75 in fees. Using the accrual method, the profit for this month would be $4,000, $5,000 in income minus $1,000 in developer fees. This example displays how the appearance of income stream and cash flow can be affected by the accounting process that is used. Now imagine the same example took place between November and December of 2019. One of the differences between cash and accrual accounting is that they affect which tax year income and expenses are recorded in. Using a cash basis accounting, income is recorded when you receive it, whereas the accrual method, income is recorded when you earn it. Following that example, using the accrual accounting, if you invoice a client for $5,000 in December of 2019, you would record that transaction as part of your income, your 2019 income, and then pay taxes on it, even if you ended up receiving the payment in January of 2020. How to explain it to entry level. The difference between cash and accrual accounting is when they document the transaction. In the cash system of accounting, you record the transaction when the cash actually changes hands. For example, if you were selling wholesale bottles and someone bought $1,000 worth and promised to pay you in the next 30 days, you would not record that sale until they actually paid you. In the accrual system of accounting, you record the transaction right when it happens. When you sell those $1,000 worth of bottles, you would record it as a sale right then. You wouldn't wait until they actually paid you. Most large companies use this system because it shows your monthly business activity more accurately, even though it is more confusing. GAAP mandates that you use this system if you have more than $5 million in sales each year. Explaining it to a mid-level. Many small businesses opt to use the cash basis of accounting because it is simple to maintain. It's easy to determine when a transaction has occurred, the money is in the bank or out of the bank, and there is no need to track receivables or payables. The cash method is also beneficial in terms of tracking how much cash the business actually has at any given time. You can look at your bank balance and understand the exact resources at your disposal. Also, since transactions aren't recorded until the cash is received or paid, the business's income isn't taxed until it's in the bank. Accrual accounting is a method of accounting where revenues and expenses are recorded when they are earned, regardless of when the money is actually received or paid. For example, you will record revenue when a project is complete rather than when you get paid. This method is more commonly used than the cash method. The upside is that the accrual basis gives a more realistic idea of income and expenses during a period of time, therefore providing a long-term picture of the business that cash accounting can't provide. The downside is that accrual accounting doesn't provide any awareness of cash flow. A business can appear to be very profitable, while in reality, it has empty bank accounts. Accrual-basis accounting without careful monitoring of cash flow can have potentially devastating consequences. Explaining it to executive level. If your business is a corporation other than an S-Corp that averages more than $25 million in gross receipts each year, the IRS requires you to use the accrual method. If your business doesn't hit those criteria, you're welcome to use the cash method. That being said, the cash method usually works better for small businesses that don't carry inventory. If you're an inventory-heavy business, your accountant will probably recommend you to go with the accrual method. The ethical dilemmas that accountants or the accounting department may face include conflicts of interest. When it comes to conflicts of interest, or even the appearance of one, you have to ensure they will not adversely or inappropriately sway your business judgments. To navigate such situations, you might create distinct accounting teams for different clients and notify all parties of the nature of the conflict.